All right, let's get right into it. Today, we're putting Trane Technologies under the microscope. We're going to peel back the layers on this company, but not based on opinions. We're going straight to the numbers.
And we're going to start with this. Just, wow, 1,074.19%. That is a massive number. The question is, what on earth is it? Well, that's the total return investors have gotten over the last 10 years. I mean, that's just an elite top-tier number. So our whole goal here is simple. How did they do it? And maybe more importantly, what does the data tell us about Trane today?
So first things first, let's dig into that performance. I mean, was that just a flash in the pan, one lucky stretch? Well, the numbers tell a very different story.
Okay, look at this. What's so amazing isn't just one big number, it's the consistency. We're looking at the average annual return here. So over the last 3 years, that's an average of, get this, 41% per year. And even if you go back a full decade, you're still looking at almost 28% a year on average. This is not a fluke. This is sustained, powerful stuff.
But, a stock price can't just go up forever on hype alone. There has to be a real, healthy business underneath. So let's pop the hood and check out the engine, see what's driving this thing.
And yep, here it is. The story here is just so clear. Revenue, the money coming in the door, is growing at a solid double-digit rate. But here's what gets really exciting. Look at net income and free cash flow. The profit and the actual cash this machine spits out are growing even faster than sales. That is exactly what you want to see. It's the sign of a business that's not just growing, it's getting more efficient as it gets bigger.
So the main takeaway here is just crucial. That crazy stock return we started with, it's not magic. It's built on a rock-solid foundation of a real business that is just firing on all cylinders, selling more, earning more, and bringing in more cash. Simple as that.
Okay, so growth is awesome. We've established that. But it's only half the story, right? The other really important part is efficiency. How good is this company at actually turning money into more money?
And to figure that out, we look at a great little metric called Return on Invested Capital, or ROIC. Honestly, just think of it like a grade for the management team. For every single dollar they put into the business, whether it's from loans or from investors, how much profit do they squeeze out?
In Trane's number, almost 21%. Now, to put that into perspective for you, most investors would say that anything over 15% is fantastic. That's the sign of a really high-quality company. So, Trane is just crushing that benchmark. But wait, it gets even better. Here's the real kicker. It's not just that the company is super profitable now. It's that it's getting more profitable. That 21% number is way higher than its average over the last 5 years. Think about that. This already elite business is actually improving. It's getting better and better.
All right, so we've laid it all out. It's a fantastic business, incredible track record, getting more efficient, which brings us to the million-dollar question, right? For anyone thinking about this stock today, what's the price tag? What do you have to pay for all this quality?
Probably the most common way to get a quick check on the price is the PE ratio, price to earnings. It's a really simple idea. For every $1 the company makes in profit each year, how many dollars do you have to pay to buy a piece of it? The higher the PE, the more expensive the stock is considered. And right now, Trane's PE is over 37. And look, that's not just a high number on its own. It's actually about 20% higher than its own average for the last 5 years. What does that tell you? It tells you the secret's out. The market knows this is a great company, and it's slapped a premium price tag on it.
And this right here, this is the classic investor's problem, isn't it? You found an A-plus company, but you have to pay an A-plus price. So, is it just too late? Is it too expensive to even consider right now?
Well, maybe not. Hold on. Because while the PE ratio is telling us one thing, there's another way to look at value. A model that tries to figure out what all the company's future cash will be worth. And that one? It paints a totally different picture.
This model, it's called a discounted cash flow model. It looks at future potential, and it comes up with a fair value price of over $767 a share. Now, that is way, way higher than the price today.
So what does that mean? It means this model suggests the stock could actually be undervalued by more than 36%. And now you've got this fascinating debate. Is the stock expensive when you look backward at its earnings, or is it a total bargain when you look forward at its potential?
Okay, so we've got this great debate going on about the price, but there's one more piece to this puzzle we need to look at. And that is, how does the company treat its shareholders, the actual owners? What do they do with all that cash they're making? And this chart really says it all.
You can see their whole philosophy right here. About 30% of the profits go directly back to shareholders in the form of dividends. The other 70%? They plow it right back into the business to keep that growth engine humming. It's a really nice, balanced approach.
And listen, it's one thing to pay a dividend. It's another thing to grow it like this. We're talking 5 consecutive years of giving shareholders a raise. And we're not talking about tiny little increases either. The dividend has been growing at over 12% a year, on average, for 5 years. That just screams confidence from the management team about what's coming next.
Okay, so let's recap the whole thing. What are we left with? On one side, you've got this incredible performance, amazing growth, and truly elite profitability. But on the other side, you have a price tag that looks pretty steep compared to its own history, even while a different model is basically yelling that it's a huge bargain. It's the classic investor's dilemma, plain and simple.
You know, it really makes you think of that classic quote from Warren Buffett. When you're looking at a company this good, your time frame, your sense of patience, it changes everything.
And so that's where we'll leave it, with the big, critical question. The numbers don't lie. Trane is an absolutely elite business. That part isn't really up for debate. The question is, at today's price, are you paying for the incredible performance that's already happened? Or are you paying for a future that's going to be even better? Because as we've just seen, you can make a really strong argument for both sides.